Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Strategies to mitigate psychological biases in investing. Psychological biases significantly impact investment decision-making, often leading to suboptimal financial outcomes. These biases, deeply rooted in human cognition and emotions, can distort perception, judgment, and behavior, causing investors to deviate from rational decision-making frameworks. Recognizing and mitigating these biases is crucial for mastering strategic investment. One prominent psychological bias in investing is overconfidence, where individuals overestimate their knowledge, abilities, or control over events. Overconfidence can lead to excessive trading, underestimation of risks, and an overreliance on one's judgment, often resulting in increased transaction costs and reduced portfolio performance. To mitigate overconfidence, investors should adopt a disciplined approach to decision-making, relying on evidence-based strategies and seeking diverse perspectives to challenge their assumptions. Regularly reviewing and reflecting on past investment decisions can also help in recognizing patterns of overconfidence and adjusting behavior accordingly. Anchoring bias, another common psychological pitfall, occurs when individuals fixate on an initial piece of information and inadequately adjust their subsequent judgments. This can lead to mispricing assets and poor investment choices. For instance, investors might anchor to a stock's historical high price and hold on to it despite deteriorating fundamentals, hoping it will rebound to its previous levels. To counteract anchoring, investors should focus on current and forward-looking data, employing rigorous valuation methods that consider a wide range of factors. Utilizing checklists and decision frameworks can further aid in systematically evaluating investment opportunities without undue influence from initial anchors. Loss aversion, which describes the tendency to prefer avoiding losses over acquiring equivalent gains, can lead to risk-averse behavior that hampers long-term investment growth. Investors may hold on to losing positions to avoid realizing a loss, a phenomenon known as the disposition effect. This behavior can result in a portfolio skewed with underperforming assets. To mitigate loss aversion, investors should embrace a long-term perspective, focusing on overall portfolio performance rather than individual positions. Establishing predefined exit criteria and adhering to them can help in making objective decisions, reducing the emotional impact of losses. Confirmation bias, the propensity to seek out information that confirms pre-existing beliefs while ignoring contradictory evidence, can lead to skewed decision-making. This bias can cause investors to become overly attached to certain stocks or strategies, disregarding negative information that could indicate a need to reassess their holdings. To mitigate confirmation bias, investors should actively seek out dissenting opinions and contrarian viewpoints. Engaging with diverse sources of information and conducting thorough due diligence can provide a more balanced perspective, enabling more informed and rational investment decisions. Herding behavior, where individuals mimic the actions of a larger group, often leads to market bubbles and subsequent crashes. This behavior is driven by the belief that the collective wisdom of the crowd is inherently correct, leading to irrational exuberance or undue pessimism. To counteract herding, investors should cultivate independent thinking and rely on fundamental analysis rather than market sentiment. Establishing a clear investment philosophy and sticking to it during market fluctuations can help maintain a disciplined approach, avoiding the pitfalls of following the crowd. One effective strategy to mitigate these psychological biases is the implementation of a systematic investment process. This involves setting clear, predefined rules for buying and selling assets, which can help reduce the influence of emotions and cognitive biases. For example, adopting a dollar-cost averaging strategy, where a fixed amount of money is invested at regular intervals regardless of market conditions, can mitigate the impact of market timing biases and reduce the emotional stress associated with market volatility. Another approach is to leverage behavioral finance tools and techniques designed to address specific biases. For instance, using mental accounting, where investors segregate their investments into different buckets based on goals or risk levels, can help manage risk perceptions and improve decision-making. By framing investments within the context of specific objectives, such as retirement or a child's education, investors can make more rational choices aligned with their long-term goals. Additionally, employing professional financial advisors can provide an external perspective that helps mitigate individual biases. Advisors can offer objective analysis, challenge biased thinking, and provide guidance based on a broader understanding of market dynamics and investment principles. However, it is essential to ensure that advisors themselves are aware of psychological biases and employ strategies to mitigate them in their recommendations. Education and self-awareness are also critical components in combating psychological biases. Investors should strive to understand the nature of these biases and their potential impact on decision-making. Continuous learning through reading, attending seminars, and engaging with investment communities can enhance knowledge and awareness, reducing susceptibility to biases. Self-awareness practices, such as mindfulness and reflective journaling, can help investors recognize their emotional triggers and cognitive patterns, enabling more deliberate and rational decision-making. Incorporating quantitative analysis and data-driven decision-making can further mitigate psychological biases. Utilizing statistical models, algorithmic trading, and financial analytics can provide objective insights that are less prone to emotional influence. By relying on data and empirical evidence, investors can make more informed decisions, reducing the impact of cognitive biases. Lastly, creating a supportive investment environment can play a significant role in mitigating biases. Collaborating with like-minded individuals, participating in investment clubs, or joining professional networks can provide accountability and diverse perspectives. Engaging in regular discussions and debates about investment strategies and market trends can foster critical thinking and help identify and address biases collectively. In conclusion, psychological biases are inherent in human cognition and significantly influence investment decision-making. Overconfidence, anchoring, loss aversion, confirmation bias, and herding behavior are among the common biases that can lead to suboptimal investment outcomes. To mitigate these biases, investors should adopt a systematic investment process, leverage behavioral finance tools, seek professional advice, prioritize education and self-awareness, incorporate quantitative analysis, and create a supportive investment environment. By recognizing and addressing these biases, investors can enhance their decision-making capabilities, leading to more rational, informed, and successful investment outcomes. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.